Hey guys, welcome back to another video. Spotting market direction and genuine reversal points can be challenging since the market tends to throw multiple fake signals before a real trend reversal shows up on the chart. So how do we spot a real reversal point using price action and smart money concepts? In this video we're going to share with you a powerful trading technique that combines smart money concepts with RSI divergence as confirmation to identify the true market structure shifts on the chart. Here's a quick rundown of what we'll go over today. First, we'll go through the functions of the RSI indicator, then we'll show the proper way to use RSI divergence, and finally we'll break down how to apply divergence as confirmation to spot reversal points when combined with smart money concepts. So if that sounds good to you, be sure to tap the like button to support more content like this and subscribe to our channel if you're new, since we share plenty of advanced trading concepts. Starting with the basics, what exactly is the RSI indicator? The Relative Strength Index, or RSI, acts as a momentum oscillator that tracks the speed and variation of price shifts. It assists traders in spotting possible trend reversals and overbought or oversold scenarios in the market. To add this indicator onto your chart, just go to the Indicators tab within the TradingView platform, then enter RSI in the search box. Once the Relative Strength Index shows up in the results, click on it and it'll be added to your chart. When the RSI moves above the 70 level, it often indicates that the currency might be overbought. This means the price has risen sharply in a short time and there could be a chance of a pullback or reversal happening soon. On the flip side, when the RSI drops below the 30 level, it generally signals the currency might be oversold. This means the price has fallen steeply in a short period and there's a chance for a reversal or upward move. Now, this is the standard way traditional traders interpret this tool. The issue with this idea is that price can remain in overbought or oversold zones for extended periods. This occurs because there's no set boundary for how far price can continue moving, and if you execute trades purely on the basis of hitting overbought or oversold levels, you'll probably face multiple losing positions. So how can we apply the RSI indicator? One powerful method is spotting divergence between price action and the RSI itself, which may indicate possible trend reversals. So what exactly is divergence? Divergence happens when price moves contrary to the direction of an indicator like the RSI, hinting at a possible shift in the ongoing trend. Here on the chart, the price has pushed above the previous structure, forming a new high, but when we observe the RSI, we'll see that it printed a lower high which formed a divergence, and as shown, this led to a trend shift. This principle isn't restricted to bullish setups and can also be applied in bearish situations. Here the price has formed a lower low, but when we examine the RSI, we'll notice it has formed a higher low, which signals a divergence. Once again, this has caused the market structure to shift from a downtrend into an uptrend. Now let's explore what the psychology that drives RSI divergence. RSI and price divergence highlight a mismatch between momentum and price movement, pointing to possible fatigue in the ongoing trend, which traders often interpret as an early sign of a potential trend reversal. Now let's go over some pro tips to enhance the effectiveness of RSI divergence. Number 1. RSI divergence is most effective when it appears after entering the overbought or oversold zones. It indicates that first, the price has moved up sharply and quickly, suggesting that a reversal or pullback might take place soon. Second, the divergence points toward a potential shift in market structure. Number 2. Apply the divergence concept specifically in trending markets in sideways or ranging conditions where prices lack direction. RSI divergence signals tend to be less dependable because there's no strong trend to follow, making it harder to trade divergence signals effectively, so ensure this concept is used only when a clear trend is visible. Number 3. Divergence is more significant after a prolonged trend. When a trend extends for a longer period before RSI divergence appears, it shows broader market participation and a strong price move. This raises the likelihood of a major reversal, offering better profit chances for traders in the new trend. Although RSI divergence is widely recognized in price action trading, it does come with certain challenges when applied in real-time trading. For example, consider this chart. In this scenario, the market is in a downtrend, but the RSI signals a divergence, suggesting a potential reversal. This might prompt traders to look for long trades. However, the market subsequently makes another lower low, and upon inspecting the RSI indicator, you observe it creates another divergence again. Now, this scenario can repeat several times until the price finally decides to reverse and begin its upward movement. Now, that's why we combine the RSI divergence with the reversal concepts of smart money trading to confirm our entry. This makes our trading plan stronger, helping us find better times to enter the market with more confirmation and confidence. So let's continue with the next topic. Pairing RSI divergence with a change of character. But before moving on, if you found this video helpful so far, please smash that like button to support our team in making more content like this. In a bullish setup, when price breaks and closes beneath the lowest point between two consecutive highs, it's called a change of character like divergence. It indicates weakening momentum, showing that buyers are losing grip and the price may reverse downwards. This support zone acted as the last line before bearish pressure and buyers failed to hold it. The key difference is that change of character happens within the market structure, offering stronger confirmation of the reversal. So seeing a change of character occur after RSI divergence presents a strong indication of reversal, especially when the divergence aligns with key supply and demand zones. Picture this chart as our higher time frame. Now let's analyze the recent price movement. The market is bullish, consistently producing higher highs and higher lows, so our general bias stays bullish. The best zone to look for a buy setup is inside this consolidation range, since it gives a strong risk to reward profile, and setting a stop loss beneath this zone offers a safer position if the market pulls back to retest it. We can switch to the lower time frame to spot entry setups for long trades. In this lower time frame, we're waiting for signs of reversal within the short-term downtrend before entering a long in line with the higher time frame. If we plot the RSI indicator on the chart, we'll notice a bullish divergence where the price makes a lower low but the RSI forms a higher low. This acts as the initial clue of a potential reversal. The signal later gets validated by a change of character, indicating buyers are now in control. The short-term downtrend ends and price can resume moving upward in alignment with the higher time frame. The same principle works in a bearish setup too. Here we see a bearish market. This move is seen as the most recent impulse that formed a fair value gap zone, so if the market retraces and revisits this area, the candles that formed the FVG become a prime trading zone to watch for short opportunities. So initially we wait for price to tap into our trading zone and then drop to lower time frames to confirm a reversal and enter short trades. Here on the lower time frame, when we use the RSI indicator, we notice another instance of divergence, so we wait for the market to validate this signal by dropping below the most recent higher low, and then we can consider short positions. But always make sure to run your own back testing to evaluate how effective your trading strategies are based on historical data. Merging the divergence signal with premium and discount zones. What should we do if the most recent impulsive move fails to display an obvious imbalance? In this case, applying the Fibonacci retracement tool can guide us in spotting crucial levels where price may rebound. The area below 50% is seen as the discount zone, while the region above marks the premium. When we have a bullish bias, we aim to enter trades in the discount zone for multiple reasons. It provides a solid risk to reward setup since the initial target is the recent high. Setting a stop loss under this lower high offers safety for long entries. Often the market removes early buyers to build enough liquidity for the next leg up, but in strong trending conditions with shallow retracements, spotting valid setups in the discount zone becomes tougher. So the core idea behind the trade, when no clear imbalance is visible in the recent price move, the idea is to let the price drop into the discount zone and then monitor the lower time frame for signs of reversal. This signal could once again be a divergence combined with a change of character. The identical concept works in a bearish context too. When the broader trend is downward, we begin with the retracement tool and wait for the price to climb into the premium zone. Then we look for confirmations on the lower time frame to initiate a short trade that follows the higher time frame direction, and once more the confirmation is a mix of RSI divergence and change of character. Merging the divergence signal with a liquidity sweep pattern can enhance the accuracy of your entries by aligning momentum shifts with areas where stop hunts or fake outs often occur. In a bullish scenario, the liquidity sweep pattern is identified by a single candle that clears liquidity below the prior low. This sweep can occur through wicks or the candle body, but the key factor is that price must quickly return to the range after the candle closes. During an uptrend, a bullish liquidity sweep indicates continuation higher, while a bearish liquidity sweep suggests a potential reversal. This concept mirrors in a downtrend where a bearish liquidity sweep points to downward continuation and a bullish sweep signals a possible reversal. Now let me demonstrate how to combine the liquidity sweep pattern with RSI divergence using an actual chart example. On the pound and 1 hour chart, recent bearish price action is clear. The price has tested this level twice, creating equal lows. Liquidity beneath a low or cluster of lows represents sell-side liquidity. When price reaches this zone, bullish traders may enter longs or defend existing long positions. Meanwhile, breakout traders will short if price breaks below this level. The swift move designed to grab this liquidity is known as sell-side delivery. Here we see a valid liquidity sweep pattern where one candle closes beneath the green line and price quickly rebounds back into the range, signaling a potential reversal as algorithmic delivery captures liquidity, trapping traders on both sides. Following this, smart money is likely to go long, targeting buy-side liquidity. Further confirmation comes from the RSI indicator showing bullish divergence as price made a lower low but RSI formed a higher low, indicating the short-term downtrend may be concluding and price could move higher. So that wraps up this video. If you found it helpful, please smash that like button to support us, and if you're new here, consider subscribing for more trading insights. Catch you in the next video.